So hey there, this is Corbin McGordon from Ennis Legacy Partners. Welcome to the Exit Readiness podcast. I'm standing in for Pat Ennis today in this last podcast of 2021, here with co-host Walter Dials, CPA and tax partner at GRF CPAs and Advisors in Bethesda, Maryland. The mission of this podcast is to provide you, the business owner, with subject matter expertise on topics pertaining to building sellable business value and for planning your eventual exit from the business. Walter, as we both know, a key exit planning element that's often overlooked by small business owners is pre-sale tax planning. It wouldn't be unusual to hear an owner post-transaction say something like, "Whoa, my tax bill was a lot bigger than I expected." Do you hear that?
I hope not, because hopefully, the clients we're working with aren't going to experience that. But I have had, I think we both have come across owners who we didn't deal with directly in the transaction, and then they're surprised how much tax they owe. And a lot of that comes down to, everybody always assumes that when they sell their company, they're gonna pay capital gains tax, and in a lot of cases that's true. But I think many business owners don't understand that there are tax differences in how your sale is structured. Namely, if it's a stock, you're selling your stock versus selling the assets of your business. Yeah. And even when you do sell the assets of your business, there are ways to guarantee that you're going to get capital gain treatment for all or at least a good portion of the sale. And that's what we're going to be talking about today.
Yeah, we were talking earlier and thought that any subject that starts with Form X would not really excite you so much. So the title of this podcast is Reducing Your Tax Liability Through the Use of Form 8594. Now, a lot of times when owners think of transaction, what gets talked about is the sale price, the price itself. And as Walter just said, what's often overlooked are the tax implications of that, because a number is a number and it's a starting point, but there's a lot that influences the eventual take home. Let's quickly refresh ourselves on the ideas of a stock sale and an asset sale. In a stock sale, the entity itself transfers. In an asset sale, the assets of the business transfer to the new owner, and that includes goodwill. Proceeds in a stock sale are taxed at capital gain rates, and the liabilities of the company continue on to that new buyer. So if there are skeletons in the closet, well, that new buyer owns those skeletons, whether they knew about them or not. In an asset sale, that's obviously different. And so the buyer prefers an asset sale, one, to avoid those skeletons, and two, they get a step up in basis for assets acquired, which accelerates depreciation and reduces the net income. Walter, can you explain that concept simply, the step up in basis and what that actually looks like?
Sure, and that is important because if someone buys the stock, you're selling your company and someone buys your stock, they basically have, let's just use an example of $750,000. They're going to have a $750,000 asset on their books, and there's no tax benefits associated with that. If, on the other hand, they pay $750,000 for your assets, depending on the type of asset, they're either going to be able to depreciate that or amortize that. Mm-hmm. So let's just do like worst case scenario for a buyer. Let's just say the entire $750 in my example is allocated to goodwill.
Yep.
They can then amortize that goodwill over 15 years. So every year they'll have a $50,000 tax deduction.
Nice.
So that's a real benefit to them. And if they're buying a business maybe that has vehicles and equipment, if they can allocate part of the purchase price to those, they're going to be written off even quicker.
Nice. Got it. No, that makes huge sense. And just that concept of depreciation / amortization, a non-cash expense, but legitimate expense, which increases your expenses, reduces net income, saves taxes. That's pretty neat.
Yep.
Yeah, so now I know there's an IRS code 338H10 that governs this idea of potentially enabling, even in a stock sale, to have some of the benefits of an asset sale. So could you address that whole concept and start with why is that even there? And go from there.
Yep. So 338H10 is a very interesting code provision, and basically it's Congress's way of acknowledging that sometimes a buyer would really like to do an asset purchase, but for certain reasons, it's not going to make sense. So for instance, a lot of times government contracting businesses, it can be a real hassle to novate contracts and move them from the existing company to the new one. So a lot of times a buyer has to just buy the company. There could be other reasons too, similar to that, in that there's assets that just aren't going to transfer easily. So the acknowledgement of Congress is basically that, okay, we understand that sometimes you have no choice but to buy the stock, but as a buyer, for the reasons we just discussed, that puts you at a disadvantage because you're not going to have any tax deductions.
Mhm.
So they put this provision in that basically, if the buyer and the seller agree, they can treat
Mhm.
a stock purchase as if it was really an asset purchase. So legally, you're doing a stock purchase, but from your tax standpoint, it's an asset purchase.
Mm.
So, you could say, well, knowing that chances are the seller is going to be disadvantaged, why would they ever do this?
Exactly.
Yeah. So there's a couple of reasons. One would be if you're a C corporation and you have a bunch of net operating losses that you're going to lose if you sell your stock,
Mhm.
you can instead sell your assets, knowing that that whatever gain you're going to have to realize is going to be sheltered by your net operating loss.
Mhm.
And because you're giving the seller some tax advantages, they should increase the price a little bit. So you come out ahead that way. The other situation where it can make sense is an S corporation. And, we've talked about choice of business entity, a number of times on this podcast. And the
Mhm.
big advantage of an S corp when it comes to selling your business is there's only one layer of taxation. Just the individual pays the tax, the corporation does not. So doing an asset sale in an S corp, assuming that all or most of the purchase price is allocated to goodwill, the seller is still going to have a capital gain because goodwill is taxed as a capital asset. But like in my example, the buyer is now going to be able to amortize that goodwill instead of just being stuck with stock that you can't do anything with. So 338H10 is really just a mechanism that turns your stock sale into an asset sale for tax purposes.
Mhm. Mhm. Yeah, so it seems like it's almost a middle of the road in that buyer seller tension of each wanting something that are somewhat polar opposites, but it's a compromise that allows theoretically a win-win, right?
Yeah, exactly. Yeah.
Yeah.
And usually it can be done in such a way that even in my S corp example, if there is going to be some increase in tax, the buyer is willing to increase the sales price to make the seller whole, knowing that they're going to be getting some good tax write-offs.
Mm-hmm. No, that makes perfect sense. Makes perfect sense. So when does this concept actually come on an owner's radar screen? Is it something that if they're 10 years out, do they want to start planning for this, or what's the time horizon for an owner to actually start digging into this whole 338 question?
Really, it really wouldn't come into play until they're ready to actually put their business up for sale. At that point, what we like to do is meet with the business owner and say, okay, if you if you do a stock sale, this is going to be your net after-tax proceeds.
Mhm.
If you do an asset sale, depending on the allocation of assets, but let's kind of go through a few different scenarios.
Mhm.
This will be your net after-tax proceeds. So at least, so they go in with the understanding of what the impact on net after-tax proceeds is going to be on an asset sale versus a stock sale. So they're ready for that. And they, generally the seller is always going in saying, I want to sell my stock.
Yeah.
And then
Yeah.
part of the negotiation is, okay, well, it's going to be an asset sale. Let's increase the price a little bit.
Yep. Very good. Very good.
But it's not something you need to, that's not an aspect of exit planning that needs to occur 3 or 5 years before you have a transaction.
Sure. Sure. No, that makes perfect sense. So now this tax form 8594, how does that come into play? I know it has 7 classifications of assets, but can you unpack it a little bit?
Yeah. So 8594 is the IRS's way of making sure that an asset purchase and sale is treated consistently by the partners.
Hmm.
So they wouldn't want a situation where a buyer or a seller says, well, as far as I'm concerned, all you bought is my goodwill, and he's going to report a capital gain. And the buyer is going to say, well, as far as I'm concerned, all I bought was your equipment and trucks. So I'm going to write them all off. That would be a mismatch. So the IRS, of course, doesn't like that idea. So they came up with Form 8594. And this is a form that the buyer and the seller both attach to their tax returns. They both sign it, and they both attach it to their tax returns. And it tells the IRS, this is how we have agreed to allocate the purchase price of our assets. And Corby, like you mentioned, the assets are broken into 7 different categories. Although for most purposes, you're really only looking at probably 3 or 4.
Yeah.
And the way it usually works is there's something called the residual method, which basically you identify the specific assets you're buying. So let's say you're buying some vehicle. Let's say go back to my example of a $750,000 purchase price.
Yep.
Sit down, the buyer and seller sit down and say, okay, my vehicles are worth 50. You're getting some cash that's worth 50. You're getting some accounts receivable that's worth 100. So that's $200,000.
Yep.
And then it's like, okay, that's $200,000, but you're paying me $750. So the rest, the $550, is goodwill.
Yeah.
The residual goes to goodwill.
Yeah.
So that's usually the way it works. It's usually not more complicated than that, really.
Got it. And as I'm listening to you, the fact that you said it a couple of times, it's important that the buyer and seller agree, and they sign the document to say they agree. Are there assets that could actually fall into different categories and be classified differently? Or is it more a matter of how much value do you place on a given asset on the form itself?
Yeah, I mean, there's usually not, the categories are pretty straightforward. So that's usually not an issue. It really just comes down to the dollar amount. So, the other thing the IRS likes about this is that there's a tension between the buyer and the seller. So they're kind of doing the IRS's work in a sense. Because, the buyer is going to say, well, I'd like to allocate, let's just say it's a company that has inventory. They may say, I want to allocate $50,000 to inventory, knowing that that's going to be a write-off they're going to get right away. Whereas the seller's like, well, my inventory is really only worth $25,000. So that's how much I want to allocate it. So there's a little bit of back and forth on that. But at the end of the day, they have to come to an agreement. And that should be done at settlement, at the closing. You don't want to try to track this form down after the fact and all of a sudden have a disagreement as to, what you thought the numbers were going to be.
Right. So then, as we know, even in the valuation world, there's an art to it as well as science, and there's flexibility that remains in the pale of legitimate valuation. Does this form require any type of formal valuation, or is it a reasonable estimate that both parties agree to, therefore constitutes acceptable fair value?
Right. So the IRS position is, since it's two unrelated parties negotiating it, it's gonna represent fair value. They're not worried about valuations. And the nice thing about the residual method is, usually the hard thing to value is goodwill.
Yes.
The residual method, you're just plugging that number in. So usually, it's not hard to figure out the value of a fleet of vehicles or some old computers and office furniture.
Yep.
So there's no need for a valuation of any type when it comes to filing Form 8594.
Yeah. Yes. So essentially, the fact that it is a market transaction, by definition, then it is fair market value, right?
Yeah, exactly.
Yeah. No, that makes perfect sense. Yeah. So it's important then that owners, as you even ponder sale and you get to that point of there's potential dialogue with a suitor, that this comes on the radar screen, that the pre-planning of taxation positions you to walk in eyes wide open rather than trying to figure it out at the deal table, and work with your CPA to actually understand the implications before you settle on a price tag, because you may want to adjust that price tag. Walter, is there anything else that owners should know about this process?
I think just the whole overriding concept that when you sell your stock, you're looking at a capital gain. If you're going to switch over to an asset sale, if you want to get capital gain treatment, you have to have allocation mostly to goodwill, because that's the capital asset. To the extent that you're allocating things to equipment, you're going to have most likely any equipment on your books you've already depreciated.
Yep.
So if you sell that equipment in an asset sale, you're going to have ordinary income. There could be, depending on your accounting method, you could have inventory on the books for which you have basis. You bought it and you put it on your balance sheet and you've never written it off. So that can be sold to a buyer, and that's not going to cost you any tax money because you're just going to recover your basis.
Right.
And that could be true for other assets, but under today's accelerated depreciation, most business assets have already been written off. So there'll be a recapture when they're sold. So just, keep in mind, if you're going from a stock to an asset sale, you're really looking for the majority of that price to be allocated to goodwill.
Yeah. So in a way, goodwill is the best category to have the most value in there.
Yeah. And when a lot of our clients are service businesses, so pretty much what they're selling is goodwill.
Yeah.
No one's interested in their old computers and their office furniture.
Right. No, that makes
goodwill can be, the other thing I've seen that can complicate the form somewhat, although it doesn't complicate the taxes, is, you can have all kinds of intangible assets. I mean, goodwill is kind of a catch-all category.
Yeah.
But I've seen valuations that say, okay, this is the value of your customer list. This is the value of your in-place workforce. Stuff like that, which it's all taxed as a capital asset, so you don't care.
Yeah.
But it does complicate things when it comes to filling out the form a little bit.
Yeah. No, that makes perfect sense. Is every CPA knowledgeable about this form, or does it take specialized M&A type experience to really do it well?
Yeah, I think it's kind of like we always talk about. I mean, this is not something anybody would make a career specializing in Form 8594, but it's like every other aspect. We talk about the attorney you choose to use or the CPA you choose to use. It's just easier if you're working with somebody who is familiar with the form and with the whole idea behind, why there is this form and the difference between a stock sale and an asset sale. I mean, anybody could look up the instructions to Form 8594, and if you're halfway intelligent, you can figure it out.
Yeah.
But, number one, you don't want to, at least I wouldn't want to pay somebody to learn how to do the form.
Right, right.
And I would hope that you're working with someone, would hope I'm working with someone who is familiar enough with the form that, just like general tax forms, it's not, I don't want to pay somebody, hundreds of dollars an hour to basically be H&R Block. I want to pay somebody hundreds of dollars an hour so that they can proactively help me plan for these things.
Yeah, yeah. No, that makes perfect sense. Yeah, and so to kind of sum it up, like most things we talk about on this podcast, preparation and understanding the turf is really important prior to getting to a deal table and settling on prices. Taxation implications are huge and can influence both take home as well as deal structure and how you get paid out. So hopefully you've got the thought that when that suitor comes, this is up there on the list of priorities. If nothing else, so you're walking in the best possible negotiating position, even if it's not on the table right away, that you understand that this card is in your hands to play. Any other final comments, Walter?
No, I don't think so. I think we've covered everything.
Very good. Very good. Well, once again, then, if you need help in planning your exit, please contact Walter at 301-951-9090 or myself and Pat at 301-859-0860. We offer no fee, no obligation, introductory conversations or meetings. If you have questions, you can also access resources at grfcpa.com, ennislp.com, and exitreadiness.com. So when establishing an account for online resources at exitreadiness.com, if you use the coupon code podcast when purchasing one of the products, you'll receive a 10% discount. So until next time and next year on the Exit Readiness podcast, this is Walter Dial with Corbin Gordon signing off.